And this is Michael Saylor.
Oh, there he is. Oh, hi, Michael. Good to see you again. All righty.
Okay.
All right,
and
guys.
we'll leave it with them.
Woohoo!
We made it.
Okay. Matt and Jeff, I've had my experiences with credit, but why don't we just start by, why don't you start and tell us about your background in credit and your experiences, and give us your, the most interesting question I have for you and for you is, given your view of the credit markets, thinking about all of the credit markets in all of the world, which credit markets do you think are most either vulnerable to disruption with Bitcoin-backed credit, or which are the best fits for Bitcoin treasury companies, and how do you see it? You start.
Yeah, so first on my background with regards to credit. So I actually was at CalPERS for 16 years. I managed a $70 billion bond portfolio of structured credit on one hand, and then also U.S. Treasuries. And so I was one of the largest buyers of U.S. Treasuries. That's part of my Bitcoin story. On the credit risk, it's more about the structured credit and when I used to do corporate credit. And where I think there's the max room for disruption is actually thinking about what Bitcoin is as an asset. It doesn't produce income. In my view, it's the longest duration asset that exists. And so I think from the credit side, you should be pairing that with the longest duration credit that you can, and that's a perpetual preferred equity instrument where you never have to repay the principal. That is a matching of the asset side with the liability side. Just like when we're at a pension, we're thinking in terms of decades, hundreds of years. How do you meet your liabilities? I think that's the best instrument, which is why when we launched our strategy, we did not do a convertible note. We kept ourselves debt-free, and we've announced ambitions to really watch what Strategy's been doing with the perpetual preferred equity that I think is super innovative, and they've done it in a couple different ways. But I think that's the room for disruption. But the disruption is not to say that the perpetual preferred equity market is small. And so I think it's telling that story, going out and educating, and we'll talk about from the fixed income side, Jeff from the insurance side, how to think about risk in this markets. I mean, the TLDR is, I think, strategy right now on the pref side is AAA debt, and we can get into the framework of actually how I think that. That's a multi-decade or long-term framework that I think for the market to accept, but in the interim, while they don't accept it, that's where alpha is made for people that can underwrite Bitcoin-backed risk and do it well.
Yeah, so I'm Jeff Walton, and now Chief Risk Officer at Strive. My background is in risk. I was a reinsurance broker for 11 years, so I sold insurance to insurance companies to protect volatility of insurance company balance sheets. And insurance companies, my background in credit, so most insurance companies have to hold fixed income products that they leverage against in order to take on risk. So a majority of the insurance market is holding 80% bonds or fixed income-like instruments, and the other 20% is equity-like instruments. So, Michael, to your question, obviously the biggest opportunity in Bitcoin is infinite duration credit markets, and to the extent that those can be built and expanded to access the fixed income market. But I do think that the insurance and reinsurance industry, the balance sheet side, not necessarily the risk and the underwriting side, but the balance sheet volatility side is ripe for innovation. And there's an industry level lid on the industry itself that is preventing the insurance industry from adding Bitcoin to their balance sheet, or even the perpetual preferred equities to the balance sheet. So I think there's avenues to tackle that with AI and Bitcoin-backed products.
Okay. Let's do an audience poll. How many people in the audience have a bank account with cash in it? Raise your hand. How many people have their money in a bank account in some kind of money market that yields more than 3%? 4%? 5%? You have a bank that yields 5%? 6%? Where do you keep your money? I just want to know. We appreciate it. But, okay, just a quick second question. How many of you would like it if your bank gave you 10%? Okay. How many people actually own an ETF that's a fixed income ETF like PFF or any kind of corporate credit ETF that generates yield? Raise your hand. Interesting.
Very few.
Yeah,
We got a lot of
much
Bitcoiners
fewer.
here.
How many people own any corporate bonds directly? Ooh. Yeah. How many people own? By the way, how many people own equity, like any kind of common equity, like a four-letter ticker equity? Okay. So it seems like, by the way, the magic thing is to take the bank account idea, crank up the yield, and put it in the equity, right?
Yeah, and maybe
is-
just one note on the actual yield. When you
Yeah.
say 10%, that's greater than the rate of fiat currency debasement, which is in the 8%
Yeah.
range. And so you've flipped the notion of fixed income from something that is being debased. So if you're in a treasury at 4.5% or something like that, or a corporate credit at 5.5% or 6%, you're being debased relative to the pace of fiat currency debasement. 10%, you're actually accreting cash versus the debasement. I think that's where you can start to become interested as someone that might need or want income depending on where you are in your life.
Anybody from Switzerland or Germany in the audience? Or what do your bank accounts pay in terms of interest? Zero? The zero travels far across the room. Yeah, so I think credit is the most fascinating thing, and it's something that I, in my life, never really paid much attention into until I got into the Bitcoin world. But I mean, I borrowed money. Obviously, I know consumer credit. I know credit cards. I've done leasing. I've done bank loans. I've done senior financing. Not quite a junk bond, and I've done convertible bonds, and I've done a quasi-margin loan from a bank, lived to tell about it. I've never done like a 40x levered loan from Binance or Hyper Liquid or whatever, where you crank it up and, to 20x or 30x or 40x. I advise against that. Sam Bankman-Fried actually called me once and he pitched me on that. He was like, you should put your Bitcoin at FTX and we can give you margin credit. I actually got pitched by the Three Arrows guys, too. I also got pitched by Genesis. I also got pitched by Celsius. I also got pitched by BlockFi. I think I got pitched by just about everyone that went bankrupt during the crypto winter.
Well, you saw it. You didn't do it, so.
Yeah, so I normally say yes enthusiastically in public, but in private I say no a bunch. But coming back to credit, the interesting thing to me is, I think theoretically, the best kind of digital credit, if we're just inventing the world anew from a blank sheet of paper, is a liquid, publicly traded preferred stock. And a preferred stock can look like a bond, and it can look like an equity. Like if you take one extreme, like STRD, it's a non-cumulative preferred, and that means that you're paying a dividend. Right now, the dividend we pay is like 12.7% or something. You're paying a dividend, but it's non-cumulative, which means that you never pay the principal back. So it's like 1,000 a year. It's forever. You never pay the principal back. You pay 12% dividend yield, and you pay that forever to someone that buys it. But if you ever were in a credit crisis or a credit crunch, you can suspend the dividend without prejudice, without penalty. Now, the company would have the option to not suspend it, or the company could suspend it and say, well, we're going to pay you back anyway. If we put out a press release saying we're suspending it this quarter, but we intend to make up for it next year, the preferred stock would fall. And if we put out a press release saying we're suspending the dividend, we'll probably never pay you back, it would fall a lot, right? And then if we didn't actually reinstate the dividend for 2 or 3 years, it would be tanked, start to look like total distressed third world debt. But what you've really got there is equity. Like you're like, why would I buy that? You're really buying like an equity that pays 12.7% dividend. And if you ever think about buying equity, you buy the equity in the company that pays the dividend, and the company can suspend the dividend, and they don't have an obligation. And a lot of people buy, Verizon and AT&T, and there's a lot of dividend-bearing equities in the world. So you can do that, but the difference is, of course, you're giving someone some precision about what it is. And when I think about that, I think, I just created an equity that's a perpetual swap where I'm giving you the first 12.7% of the Bitcoin return forever, and then I'm taking back the rest for my common stock shareholders, and I'm giving you a liquidation preference, and I'm giving you some more certainty, and I'm giving you a commitment of the company that we're going to do it. So that's one extreme credit instrument. The other extreme, would be you have a preferred and you basically say it pays this much, it's cumulative, there are penalties, and you have a put right. There's a call, there's a put in 3 years or whatever, you can put it back to the company, and that starts to look like debt. And if you, in the extreme, you can make it look like perfect, like super senior debt. And I think the beauty of that preferred instrument is it's a programmable container, and you can program that container with any amount of delta. You can put 60 delta, 80 delta, 10 delta. You can put any conversion rate. You can put any duration. You can put any credit duration. You can put any yield duration. You can put any representation. You can put any penalties and rates you want. You can stack them all up, and you can put it in any currency basis you want. You could even plug in all sorts of floaters and indexes. You can index it to SOFR and index it to the Japanese bank rate. So you can do pretty much anything, and that's the beauty of those instruments. If you're a public treasury company, for the most part, you can craft a perfect piece of credit, and you could sell it 144A, or you could take it public. But my view with credit is the real innovations are you create a credit instrument that you can sell to the public as easily as they can buy an ETF. And then the next innovation is, can you get it on the NASDAQ? And then can you get it on other foreign exchanges? How many exchanges can you get it on? And then the next innovation is, can you put a shelf registration on it? And after you've done all that, then the question is, what's the collateral backing it, and how do you want to run the rest of the company? And I think it's you can lay out the perfect ideal strategy, but coming back to the impediments, and I'm going to ask you guys about these. Right? The impediments to doing that are, if you do it unrated, you've got to go market that instrument to public investors and retail investors that will buy an unrated instrument. So you have a marketing lift. If you want to sell that to the insurance industry, I think there's organizations like Mercer and the like that are creating model portfolios, and they're gatekeepers. And then you have the credit rating agencies like Moody's and Fitch and S&P, and they're also gatekeepers. And so what you find is the conundrum is the stuff that's easy to sell, you don't want to sell. And the stuff that you want to sell is not easy to sell. And we're at this crossroads right now where the question is, do we create the perfect instrument that could scale up to tens of billions? Like Stride for STRD, you could sell 100 billion of it risk-free. You could sell 1 trillion of it risk-free. Right? So there's some things that you definitely want to sell that are new, and then there are other things that the market wants to buy, like they want to buy a 3-year bond with liens on all the company's assets, senior in the capital structure, and that of course creates massive amounts of risk. So I guess I start with you and say, how do you think that the existing credit establishment will evolve, and can we actually bring over the Mercers and the S&P and the the Moody's and the Fitch credit rating agencies and sell these things to the traditional institutional investors, the pension funds or the whatever? Or do we have to actually completely build a new market of new investors, new credit rating ideas, and sell it to a new, a new product to a new set of investors?
Yeah, I think the answer is both, and I'll give you an analogy to why I think that's the case. After the great financial crisis, in structured credit around mortgages, there evolved new rating agencies that started to rate debt because they took advantage of an opportunity that the market's confidence in the traditional rating agencies plummeted after the great financial crisis. And so you started to see new rating agencies rating commercial mortgages and stuff like that, and CalPERS used them because their models were really innovative and they were strong. So I think there's an opportunity for startups to, in a thoughtful institutional way, think about a credit framework for Bitcoin-backed credit. On the other hand, I think that also creates competition for the incumbent rating agencies. And so just like when Strive was founded and we were competition against the BlackRocks and the Vanguards of the world, we were a check on the system that if you don't actually start to consider to rate these, this startup's going to take your business. And so I think it's both there. And then on how do you evolve it into the market, when you start issuing securities that aren't rated, for most actively managed income funds, they usually have a bucket where they can either rate themselves or buy unrated securities. So you start to see people like the capital groups of the world start to buy it from an institutional perspective, which then on that end puts pressure on the rating agencies to rate them because the asset managers are buying them. And so I think having more issuers, more Bitcoin treasury companies issue preferred equity, innovation, that has more issues in the market, which makes the rating agencies care, competition on the rating agencies, and then asset management adoption. So I think it eventually happens, but I think it's building out that ecosystem.
Jeff, what do you think about the gatekeepers and the traditional credit investors, and how will the market evolve, and how would you approach it?
Yeah, I think you got two sides of the coin here. You've got the risk story, and then you've got the regulatory hurdle. And the risk story is actually incredibly compelling because thinking about the risk framework here of these different instruments, you can calculate it 24/7, 365. This is unlike anything that's ever existed before, like a traditional fixed income instrument that's a function of future cash flows. You may not know what those future cash flow, the sustainability of those future cash flows may look like until each quarter. You get the quarterly earnings results, or I guess every 6 months, as Donald Trump has let us know now. So you've got two pieces of this. You've got this risk story, which I think the right message needs to be explained, that you can calculate the mathematics of the risk of each of these individual instruments 24/7, 365. You can run Monte Carlo simulations and have an understanding of the probabilistic distribution.
Because they're digital.
Because they're digital. Yeah, it's the same infrastructure. And then on the rating agency side, in the insurance market, there are, similar to the banking industry, there are multiple different rating agencies that provide capital adequacy framework for the market. The old guard is AM Best, but there are these new rating agencies that are a little bit smaller that the entire industry doesn't adopt, where they're a little bit more flexible with capital requirements, so that to the extent the insurance industry shifts away from the old guard into these different rating agencies.
So we need to orange pill them.
You need to orange pill the newer rating agencies.
So, I think we want to take some questions from the audience. If anybody has questions, this might be an interesting group. So while you're working that out, I guess the observation I make is there's a lot of mortgage-backed credit. We securitized real estate. Think about how big that got. There's a lot of corporate credit. We're securitizing cash flows of corporations. There's a lot of fiat credit. We're securitizing the ability of a company to print more currency and to win their wars, right? And now this, I see, is the industry that creates the digital credit. And everybody in the room is at the beginning, year one of the creation of digital credit. And you can go out there and brag, the most successful corporate bonds in the last 5 years are digital bonds. The most successful convertible bonds are digital bonds. The most successful preferred instruments are digital. Right? When you put Bitcoin, when you put a collateral asset appreciating at 50% a year and even 30%, even if it's 20%, the truth is, if Bitcoin only appreciated at the rate of the S&P, every single credit instrument built on top of it would outperform every other credit instrument. because every other credit instrument I just named underperforms the collateral underperforms the S&P. So we're on the verge of the creation of a digital credit market that right now it looks like 20, 30 billion a year. By the way, I'm going to throw that, that's a throwaway. It's 30 billion a year and no one's noticed it exists yet. It's 30 billion a year. And the Wall Street Journal and the New York Times and Ford, they haven't noticed it exists yet. But we're about to go to 50 billion and 100 billion and 200 billion. And so think about $1 trillion of credit. And when it's $1 trillion of credit, it's not 1% of the credit in the world. And people still don't notice it exists. And so the real opportunity for all these companies is to issue billions, then tens of billions, then hundreds of billions of digital credit. And the reason that your equity is going to go to the moon is because the equity is going to be valued based upon the spread between the credit you're selling, right, and the underlying asset you're buying. And you'll be able to capture that with massive amount of leverage. The more credit you issue, the faster the credit you issue, and the better the credit terms, the more valuable the equity is going to get. So, question?
Yeah, hi.
Yeah.
I have a question. So I've been following MSTR since you guys decided to make the pivot into the Bitcoin strategy and trying to follow with my own company as a small private software company. And I thought, Michael, what you said earlier today when you said you really didn't know, in a humble way you say, you don't know about the company that you became. You couldn't predict that back in 2020 or 2022 until you found this. How do you view that towards the future and how to value MSTR or a company like this issuing all kinds of securities? How much, I guess what I'm trying to say is, how much of that do you think is predictable versus if you're buying MSTR equity, you're buying a call option on future products that we don't know yet? So
How do you value Microsoft or Google in the first year after they went public? How did you value Amazon the first year after it went public? How did you value, Facebook the first year after they went public, the stock crashed, It actually, it traded at 40% of the IPO price or something. So I think we're so early in the first year. It's very, very difficult. You got to look at all these companies, and at the end of the day, the management teams, they have the world to create. And if Metaplanet can go from a $5 million hotel company to a $5 billion entity in 12 months, and they have yet to issue their first serious credit instrument, it's like, yeah, I think Metaplanet will be the most valuable hotel company in the world. I think they'll also be the most valuable company in Japan. And every day I get up and I'm like, crap, I have to go to work because the Metaplanet people are going to outrun me if I don't. Because I'm sure Simon and Dylan are cooking up something. And I'm like, oh, jeez. Okay. So, but that story could be told in 100 markets. And within one market, when you just go to US, you're like, okay, well, who's going to own insurance? Who's going to actually partner up with the first bank to offer the 8% bank treasury account? There's so many, at the end of the day, everybody's got limited bandwidth and there's so many things to be done. We're talking about rebuilding a $300 trillion market. And if we wanted to swap out 10% of it, that's $30 trillion of stuff that has to be done. That's room for $30 trillion companies, right?
Yeah, and even to go one layer deeper on that, you think about insurance company or a bank company, but also how much leverage. There's different buyers that care about different leverage profiles, the different types of innovation in the pref market. Those are going to be real differentiators of both risk and return across the ecosystem to be built out, and one company cannot be every single one of those things to everyone. And obviously there's going to be the largest company with Bitcoin holdings ever in strategy, and then there's going to be companies that take more risk or smaller, the growth companies. There's just so many different ways to differentiate.
So the future is bright, but it's very bright. Next question.
Hi, Michael. Do you think that at some point in the future, indices such as the S&P will have to outperform Bitcoin? Because from an investor's point of view, why would someone take on the operational risk of investing in an equity when they can get a superior return in an asset that you can self-custody? And if we do reach this hypothetical future, will it still be a profitable business model to borrow against the Bitcoin as collateral to purchase more Bitcoin?
I kind of expect that Bitcoin will outperform the S&P forever because the S&P is always going to be loaded down with real-world assets and entropic conditions. The companies are going to be currency derivatives, and they're going to have real-world assets that depreciate, and there are going to be political issues, and there's going to be chaos and war and expropriation and tariff and taxes and all of those things. But in theory, if the majority of the index was made up of, if the S&P 500 was made up of 500 Bitcoin treasury companies, and they were all well run, and if the politicians didn't expropriate the assets of the companies, then in theory the S&P is a very interesting index. But I don't think we're getting there anytime in the next 30 years. I think what will happen is Bitcoin companies will creep into the index, and as they creep into the index, they will improve the performance of the S&P, and the S&P will start to creep up. Our client will be improved while Bitcoin will grow, mature, and it'll decelerate based upon the fact that it gets integrated into all other aspects of the economy. And that's what I think. We can speculate hyper-Bitcoinization world where everybody's a Bitcoin treasury company. What does that mean? But that's not in the next decade. And so I don't think it's all that constructive to speculate, because the difference between you being 10,000x more than what you are right now is what you do between now and the next decade, right? And if you tell me what the perfect thing to do is hypothetically 25 years out, well, like, you know, in the long run, we're all dead. Sorry, that's Keynesian joke. Go ahead.
Yeah, I had an additional question I just want to add on this. I'm curious to think about how you view the liquidity profile of the preferred instruments and how that conversation and communication goes with the fixed income investors, because as Matt and I have been contemplating a lot, these are far more liquid instruments than anything that's ever existed in the market from a fixed income perspective. And does the market conceptualize that? And does that mean anything? Is that important?
Yeah, well, I think the liquidity is important, right? And I think that the traditional status quo is most well-run companies aren't in the business of issuing securities strategically. They're in the business of buying securities. If you look at the net capital flow, I would guess that most great companies, they're buying, 95% of the capital flow is them buying, not selling. So they're buying their equity, and the only companies that are selling credit are either doing it as a tax arbitrage, or they're doing it apologetically, and they wish you didn't notice. And so no one is strategically issuing credit, which means that all the credit instruments that issued are a regulatory arbitrage or a requirement. They're all, and to be blunt, they're all garbage. So most preferred stocks issued are garbage, therefore they're not good investment instruments, therefore they don't have a lot of liquidity, and no one in the traditional market ever wanted to make them good instruments. JP Morgan could sell $50 billion of a preferred with $1 billion or $2 billion of liquidity a day with a bid-ask spread of a penny, but that's a 21st century idea, and the 20th century idea is most of these things are sold in discrete chunks, 500 million to $1 billion at a time, and they trade over the counter, which, in my opinion, is an antiquated approach. So the market's antiquated, and it's not really commercialized. And what we're doing right now is we're building a non-crippled instrument. It is 10 to 100 times better, but the market's been conditioned based on antiquated garbage. How many people in the room own a preferred stock? Other than one of mine. Other than one of mine. Okay, now contrast that to the number of people with a bank account. Okay, the preferred stocks pay more than the bank account, but you can see it's like 100 to 1 in favor of certain. So the market's conditioned to buy equity and to use banks. It is not conditioned to buy these other things. And we have to grow the industry, and partly it's a chicken and the egg, like, well, they didn't buy it because it was a garbage product. Okay, now we have a good product, and people go, yeah, but nobody buys those kind of products. Well, the other products, our plane has got a nuclear reactor in it, and it flies, you know, forever. It's like a hover car, and the other cars are like donkey carts, you know, and you have to convince the world you've got a better one, then you can get liquidity. And how long that's going to take is anybody's guess, right?
Yeah. But one thing that's interesting, just in the insurance world, one of the reasons the entire reinsurance industry exists is because the insurance company can't sustain a catastrophic event, right? So they buy reinsurance to protect against catastrophic events, so they don't have to liquidate their illiquid assets and take a huge hit on them, because the reinsurance market is providing coverage. So this concept really like flips the entire insurance industry upside down, because that liquidity profile may reduce the need for reinsurance for these insurance companies in the future if they were to adopt these more liquid, higher performing assets.
So we're over time. I'm going to kick these guys out, or should we keep going? What do you think? Little ply? Yeah? We'll keep this one going.
We should stay on schedule.
I think we found a format that Michael likes, so we're going to keep going with this one. We'll do a couple more questions here.
Hey, Michael. This is Nick at BitGo. Nice to meet you. So I had a question that is, your last answer to the previous question is a good segue, which is how do the operators of these treasury companies effectively operate the companies that it lasts 10, 100 years? Is it having an underlying business with liquidity? Is it long-dated debt? Maybe the obvious answer is yes to both, but curious of your nuanced response to how operators can effectively launch a treasury company from scratch and make it succeed.
I think it's simple. You raise as much equity capital as possible. You buy an appreciating asset, Bitcoin, and then if you enter into any kind of credit transaction, you obsess over the credit risk. Like how do I bankrupt the company? Let me reverse it. I raise $1 billion, I borrow $1 billion, I buy a bunch of Bitcoin mining rigs that depreciate 50% a year, and I borrow the money for 12 months and I pay 15% interest and I have to pay it back in 18 months. So if you borrow short term and buy depreciating assets, you'll be bankrupt in 36 months. If you borrow long term and buy appreciating assets, you'll be around forever. The challenge is just what I said earlier in my presentation. The people that want to give these companies money are going to want to give you the money and take short-dated senior credit instruments. And if, like, here's the hierarchy. A pipe, that's the worst way to get money, okay? And what I mean by that is if one credit investor approaches a company and offers to invest, and then they craft all the covenants, they make themselves senior, they give themselves liens on everything, right? There's no negotiation, there's no liquid market, right? That person basically has a chokehold on the capital structure. That's why you don't really want to negotiate with one company on a credit transaction. The next best is 144A. You're selling a bond, a junk bond or a convertible bond to up to 60 investors, one market maker. It trades over the counter, which means it doesn't trade. Over the counter means it doesn't trade. It's very illiquid. The next best is you take something public and you sell it to 100 million people. That's good, right? That's hard, right? And so I think that you just want to be very careful about what kind of money, what kind of credit you sell, who you sell it to. And it's one of those things where the easiest credit to sell is the most constrictive to the capital structure. And the hardest credit to sell is probably the most profitable thing you'll ever do.
Michael here.
You can cut us off when you want, Ed, but you just decide how long you want to go.
So we're all talking about a dollar yield. Basically, all of these instruments pay yield for people who want interest in dollars and so on. I'm wondering what do you think about all of these kind of products, but for a future in Bitcoin. So me as a Bitcoiner, I would like to get Bitcoin yield, which is very hard to get. You need to, let's say, exposed to risk and so on. But I believe that the real future is when we start getting all of these products. But for Bitcoiners, where we can actually get Bitcoin interest, I believe from the buy side that you are one of the only few companies that could do something like this. Maybe by raising Bitcoin and lending to the ETFs and whatever.
Thank you for the question. Let me be blunt. That is a ticket to bankruptcy. I don't think you should do that. Bitcoin is going up 30% a year. So if you agree to pay a Bitcoin dividend, you are borrowing money at a 40% interest rate. And so my view is you ought to borrow money at 10% or less, and you ought to invest it at 30% or more. When you talk about Bitcoin yield, you're inverting it. You're basically saying, I'm going to give you 60% interest, and I'm going to go find a way to outperform that. And the whole premise of the industry is there's no way to outperform Bitcoin. Okay, so I'm not a fan. I don't think you should do it. I don't believe in Bitcoin dividends. I think that what you ought to do is fund in the weak currency, the yen, the Swiss franc, the euro, the dollar. You'll pay anywhere from a base rate of 0% to 4%, tack on 400 basis points, give that to credit investors. If you want a Bitcoin yield, my answer is buy the equity. Right? The way that we give you Bitcoin dividends is you buy the equity and we generate BTC yield. You can do it safely in the equity, but the point is we don't promise you 30% BTC yield for the next decade because that's impossible to promise. So I leave the yield for the equity and then fund with the credit. If you get that inverted, yeah, of course, all the Bitcoiners would love to get the Bitcoin dividend. Of course they do. But the point is, you've just found a way to borrow money at 60% a year. And now you've got to go invest it at 80% a year return to capture 20. I just think that is like a bomb in the balance sheet. I think it blows you up. That's my opinion, and I have very much, discouraged people from agreeing to pay the Bitcoin return for their debt.
Thank you for the question. I'm curious, in my mind, the credit instruments issued by Bitcoin treasury companies compete head-on with sovereign debt instruments. If you agree with this, I guess is the first question, and if so, how do you expect sovereigns to respond?
Yeah, I don't agree with it because, as a practical matter, nobody that buys sovereign debt will even talk to us. Like there is zero chance that someone that's using sovereign debt is going to swap out, their sovereign debt for a Bitcoin-backed credit instrument, right? We can't get rated. We can't get an investment rating. If you did get a AAA investment rating, if you were Apple with a AAA investment rating, you still wouldn't be viewed as competitive to sovereign debt. So if we climb up the ladder and we get AAA investment grade rated, we will be competing against Microsoft and Apple debt. And right now we're competing against private credit and junk bonds and ETFs preferred. So really that's the market, junk bonds. By the way, our debt trades at the same level as distressed debt, basically bankrupt companies going bankrupt. That's what it trades at. So it's not a problem, right? Sometimes the Bitcoin maxi thing is, well, oh no, you're going to topple the government and collapse the currency and blah. What happens when the politicians figure out that you're going to collapse the dollar? It's like, not a risk, not this decade, not in the next decade. What we're trying to do is eat the junk bond market. And then we want to eat the corporate credit market. And the CFO of Microsoft may get some pressure from us in a decade. But right now, if you were to talk to Apple and Microsoft, they don't think they're competing against Bitcoin-backed bonds. And certainly the Treasury Department and the Bank of Japan doesn't think that either. And so I don't think it's a helpful narrative. I think it's a distraction. And what you ought to do is focus upon why this digital credit is better than junk bonds and private credit and a bunch of other things that people buy.
Hi, Valentina from Patagon Markets here. Firstly, thank you so much for being here. And I just wanted to ask about, not now, but in a future where these digital asset treasuries might want to start putting their capital to work. What do you guys think about the admittedly very risky possibility of lending Bitcoin, but against private market secondaries, which tend to offer similar returns to Bitcoin at around 30 to 50% a year as a means of de-risking, as opposed to lending it against private stock?
I think that there's a host of ways to put it to work. For example, when we sell credit, we're putting our capital to work. So when I sell Stride at 12.5% and you give me $1 billion, I generate $1 billion of Bitcoin yield up front, and I get about 80% to 90% of the back-end economics. And so the company makes $10 billion over 10 years when we sell Stride. That's a way to put it to work. By the way, what's the problem with it? I have to sell it. Like, would I sell $1 trillion of it? Yes. Can I? No. So there's a lot of ways like that. Stride, any credit instrument. I could sell a lot more convertible bonds. They have a 3-year duration, and they have a much wider credit spread, and they have a lot of credit risk. I could try to sell junk bonds. Now, what I said was, I could go write reinsurance, right? That'd be a new kind of risk. I could go borrow money by pledging my Bitcoin, and now I take counterparty risk to the borrower. There's a lot of, I got a chance to put my money with FTX, Genesis, BlockFi, 3 Arrows, and Celsius. They all came and sold. The salespeople will knock on your door and give you the offer. All of them have different risks. So I'm not going to say what a Bitcoin treasury company should do. They're going to have a stack of capital, and their choice is, do I want to do a deal with a bank? Do I want to do a deal with a crypto exchange? Do I want to do I trust the DeFi protocol? Do I want to put my, Bitcoin out on do I want to put on the ETH network, the Solana network, the whatever network? Do I want to post it to Hyperliquid or Binance? They're all counterparties. And there's no right answer, right? Except in theory, the right answer is I keep my Bitcoin and I use it as collateral and I borrow money and someone else gives me the money. That's right way risk. When I do that, the only risk we have is the custodial risk. Don't lose the Bitcoin. In theory, that is the risk-free way to generate yield. It's a good gig if you can get it, right? You just have to be, what do you mean? You have to go sell the credit instrument. So selling prefs to the public market is the hardest. Selling prefs in 144A transactions is easier. Selling bonds in 144A transactions is easier. There are other Bitcoin companies, they post their Bitcoin on exchanges, they borrow against it. The issue is, who's the counterparty? Do you trust them? Is it a good deal? Maybe. I can't endorse it unequivocally, right? Because that was the brilliant, idea of Genesis, and they went bankrupt. At some point, someone will mismanage a credit control. Here's what I say about this in general. Every company, public or private, is free to use their collateral the way they like, and there's going to be 100 different things you can do. But it used to be everybody got in the reinsurance business after the last hurricane, and that because every company got wiped out, and so they all launched the new reinsurance companies. They're like, this is great, we're getting 12% cash on cash yield. Then they all got wiped out by the next hurricane. So sometimes it looks good and it's too good to be true, and then it doesn't, but they're all just different businesses. Private companies can move into any of them. They can. Here's what I say about a public company, and I'll shut up. The thing about a public company is the reason the equity has value is because the equity investor understands your business model and wants to own it, wants to own a piece of it. So for example, if you gave me a choice, would I rather make $1 billion a year selling preferreds? Or would I rather make $5 billion a year selling some preferreds and doing some hedge trade and selling derivatives and borrowing some money and writing some reinsurance? As a private company, if you have a large ego, the answer is the latter. As a public company, if you've lived through 30 years of pain and agony, and if you've been humbled having done a bunch of things, and you've seen what works, you would choose the former. I would rather make $1 billion in a simple way that's transparent than make 5x that much in an opaque, heterogeneous way. And the reason why is because the people on the other side of the trade, the investors, they need to be able to understand your business, and they need to understand it in a split second. And as soon as you take on each additional counterparty, you create new attack surfaces for the short sellers, new attack surfaces for the complexity, new risks, new sources of entropic lapse. And so this manifests itself in the Wall Street business, where it's like you're a hedge fund and you have PhDs at Goldman Sachs and you make billions of dollars doing complicated crap. You trade it like 5 times, 6 times earnings. You sell sugar water like Coca-Cola and you trade at 40 times earnings. And one business is dirt simple. Apple selling the iPhone, their P to E tripled. Apple doing something we don't understand and a lot of different things that are cool that are hard to do. It's, if I don't understand it, the P to E's collapse. So I think if you decide to do it, I would say the company, the treasury company, should just do that thing. And they should focus on it, because you want your equity investors to believe in the same thing. Whatever counterparty risk you're taking and whatever kind of credit risk you're taking and whatever execution challenges you're taking, you want everybody on the equity side to understand, because the final boss, the people that let me do what I do, are the equity investors. And every week I put out a press release. It's like, okay, well, that was the Bitcoin yield. And the equity investors want Bitcoin. And so Bitcoin yield going up, good. Bitcoin yield going down, not good. That creates the trust. And at that point, you'll bring hundreds of billions of dollars of capital to you because people understand it. When you get heterogeneous, complicated things, then you lose the connection to the equity investor, and now your multiples collapse, your premiums collapse, your liquidity collapses. Yeah, you want to be so transparent that the haters, I want people, like, do you know we're the most shorted stock and the most shorted security in the entire crypto ecosystem? Like 3 times as shorted as IBIT. That's a badge of honor for us. What that means is everybody trusts us to be long Bitcoin, and they want to short the thing that's double long Bitcoin if they want a short position. So every time you come up with another idea, you dilute that, you distract, you make more complicated, and things that make total sense for a private company or a private hedge fund guys don't always make sense for a public company because of the reflexivity throughout all the layers of your other creditors and investors.
Thank you, Matt Cole, Jeff Walton, and the other guy over there. And
thank you.